You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started first with Strategy Spotlight.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
In today's Strategy Spotlight segment, we're joined by Russell Rhoads of the Chicago Board Options Exchange and an instructor for the SIBO Options Institute, as well as the OIC. Welcome, Russell.
Hey, thanks for having me, Joe.
How about if you tell our listeners how you got into this business?
Oh, my goodness. The way I got into this business was very similar to how a lot of Chicagoans got into this business, or Chicago transfers got into this business. Out of college, moved up to Chicago and became a runner on the floor of the CME group in the meat pits, and then pretty much worked my way up from there. Unfortunately, fortunately for investors, with the advent of electronic trading, that's not really a route for anybody these days. But worked my way up to being more of an upstairs trader, which was fortunate for me, and spent about 20 years working as either an equity trader or an equity option trader for mostly for hedge funds.
Fantastic. The meat pits. I mean,
yeah, I know. There's a lot of very, very nice fellas in the meat pits, and we'll leave it at that.
Okay, we'll leave it at that. But maybe we'll have to come back on another show and just do a piece on the meat pits.
Oh yeah, absolutely.
I know you're a big part of SIBO's Options Institute. Why don't you tell us a little bit about your responsibilities over there and part of the team you work with?
Sure. I'm one of the 4 instructors here at the Options Institute. The other 3 guys actually have more floor trading experience than I do, but I have a little bit more upstairs trading experience than they do. I'm the youngest of the 4 instructors, so I actually spend more time doing some of our college outreach stuff. And then I also, since I have an institutional background, I tend to do a little bit more of the institutional related classes for the Options Institute. So I kind of straddle the middle group there a little bit and spend more time talking to institutions and the younger people.
That's a dynamite combination.
It is. It makes things interesting, and it keeps things very fun as well.
Fun is good. Well,
yeah.
How about if we roll into this strategy spotlight segment? You wanted to talk about calendar and diagonal spreads using weekly options. So how about if we start by defining for our listeners exactly maybe what a calendar and diagonal spread are?
Sure. Calendar spread, and that's the way we normally describe them in that order. We start out with the calendar spread, and then we take it a step further to a diagonal spread. But a calendar spread basically involves a long and short position in the same type of option, either a long a call and short a call, long a put and short a put. They both have the same strike price, but they have different expiration dates. And typically you are short a near-term option contract and long a longer-term option contract with the idea to benefit from the time decay differences between the two. The diagonal takes that just a step further, and you typically will buy, for the long side, you'll buy an in-the-money call option or an in-the-money put option, which means you're buying a longer-dated call option that has a strike price lower than the near-dated call that you're selling, or you're buying a longer-dated put option that has a strike price that is higher than the nearer dated put option that you were selling. And again, in this case, you might have a little bit more of a directional bias, and you're definitely trying to benefit from the time decay differences between the two.
Good explanation. I think we'll come back to the diagonal. That's,
Sure.
as I say, good explanation, but a lot for especially our newer option users to kind of grasp. So let's go back to the calendar spread, and you wanted to specifically focus on the idea of using weekly options. Talk about that a little bit.
Well, absolutely. You know, Joe, we've had weekly options for, over 3 years now on equities, and we're up to having weekly options listed on well over 150 different stocks. So just about any stock that has an actively traded option market on it has short-dated or weekly option contracts on it. Now, the benefit to using weeklies versus that we didn't have before weekly options was the rapid time decay that you get from the last few days of life for an option contract. I mean, by definition, a weekly option is only around for 7 trading days. And when you're taking a look at selling an at-the-money weekly option, you're getting a lot of bang for your buck from the time decay that occurs over those 7 days. That's one benefit. Another potential benefit is that since we're talking about option contracts that have 7 days or fewer to expiration, you have more short-term opportunities to maybe take in some premium and try to benefit from some rapid time decay.
Is there much more risk with these spreads when you're talking about weeklies?
You can look at it both ways. If back before we had weeklies, sometimes you'd want to maybe put on a calendar spread, and your only choice would be selling an option that has 15 or 20 days remaining until expiration. So you're taking on a position for a longer time period than you might want to. On the other side of that, sometimes short-term price moves are a little bit more difficult to predict than longer-term price moves. So you can think of it as having some extra risk from that standpoint. But you're also, again, that extra short-term risk that you might be beholden to is going to be offset by that extra time decay benefit that you get as well.
And how about, as you said, it's a spread where you buy time. In your experience, do most investors typically do it for the same period of time that they buy, or does it vary?
It actually varies. There are some investors that will try to consistently take advantage of short-term time decay, and then there are other you use the word investors, so I'm going to have to throw the word traders in there. There are some shorter-term focused traders that you might get a spike in a stock that you think is in a long-term downtrend that you might consider trying to sell an option when you've gotten that spike, or maybe you see an increase in implied volatility and you see a little bit more time value than you think is justified by your outlook on the underlying stock, and maybe you're reacting in a little bit more dynamic fashion.
And can you do these calendar spreads where they're, say, bullish, bearish, or neutral, or are they typically neutral?
For the most part, calendar spreads are neutral. That's really how they're usually depicted. But you can always choose a strike price that's a little bit higher or a little bit lower than where the stock is at the current point, and try to be a little bit more surgical in your trading outlook. Although at times there are probably better spreads than a calendar spread to do. So for the most part, a calendar spread is really thought of as a neutral trade.
So where do we want the stock to be at expiration?
We want the stock to be at expiration about a penny lower than the strike price in the case of doing one with calls, or a penny higher than the strike price in the case of doing put options.
And why is that?
Well, the reason I say that is you would not have automatic assignment on your short option at expiration if those options are out of the money. And you would expect that being very close to, but not on the other side of the strike price, you would have the maximum value from the long option, which is still an open position.
That sounds like a really important point for our listeners. So the target for the underlying at expiration is just below your short strike. Is that right?
In the case of using call options, it's just below your short strike. In the case of using put options, and we typically see these things displayed with call options, but you can do them with put options as well. It would be slightly above the strike price. Makes
sense. Before we roll back into the diagonals, how about if we take a theoretical $50 stock? How would what strikes would somebody use if they wanted to do a bearish, calendar spread?
Well, if you're thinking about doing a bearish calendar spread, it would be partially dependent on the strikes that are available. And since Joe and I have been around for a while, I'll just make an assumption that for our $50 stock, we have $5 increments. Very often, especially with weeklies, you'll have stocks that have dollar increments between strikes. But if there were a $5 increment and you had a somewhat of a bearish outlook, you'd be taking a look at the 45 strike put options. And you would possibly sell, let's say just to make it simple again, you'd sell maybe, let's say it's a Thursday. You might sell a 7-day 45 strike put, take in some premium, and maybe buy an option that expires a month or two down the road, a put option that has a 45 strike as well.
Very good. And so if we were going to do a bullish one, we had that $50 stock with the $5 increments, we'd be talking about using the 55 strike.
We'd be talking about the 55 strike. But just one point I want to throw out there is every time I get a question about an option strategy, and it starts out with, what do you think about buying, the XYZ 100 calls? My response is always a question, and that question is, well, where do you think the stock is going, and what do you think the time frame is? So in the case of your $50 stock, if you have a bullish outlook, you also need to have a target price in mind as well, or where you think the stock's going to be at expiration.
So there is a connection between the underlying price and the option?
Absolutely. Although from some of the questions that I get sometimes, you wouldn't think that.
I mean, it's true. And
yeah.
It just, it's a point that we take for granted, but so many investors, until they really get into the space, don't put that together.
Yeah.
But that's why we're here talking about it, right?
Oh, absolutely. Absolutely.
Well, how about if we roll into the diagonals? Now, you gave a good definition earlier, but you're talking a lot of different strikes. Why don't you offer that one more time just to make sure the listeners get it?
Well, sure. A diagonal spread, in the case of using call options, would involve buying a longer dated option, but also buying a longer dated call option that has a lower strike. And I'm going to stick with, Joe said, use a $50 stock example. So a diagonal spread would involve buying a longer dated, maybe 45 strike call that's in the money, doesn't have, a ton of time value there, and then selling a near dated call option that's at the money, or a 50 strike call option that has has time decay working for you there. In the case of a bearish diagonal spread, you might buy a higher strike put option that's got more time to expiration, or like, let's say, a 55 strike put with a couple of months to expiration, and then selling again the at the money 50 strike put option that's hopefully going to work out for you with more time decay than the outcome of the long option contract.
And how about the primary risks to these diagonal spreads?
The primary risk for both the calendar spread and the diagonal spread is the premium that you pay when you initiate one of these trades. And you should pay out some sort of premium when you initiate one of these trades. A longer dated option contract that has the same strike price is going to have more time value, and then the in the money option contracts that you would use with respect to a diagonal spread, there's going to be some intrinsic value and some time value there. So you are going to pay out a premium, but that is also your maximum potential loss in the case of doing one of these trades.
And when we talk weeklies, I mean, how likely are we to be assigned early with these types of positions? Is that a problem from a managing standpoint?
Early assignment is always a concern. However, and this comes directly from some of the OIC literature, the likelihood of having early assignment goes up tremendously when a stock's getting ready to pay a dividend. There are some dividend capture trades that can increase your risk associated with potentially early assignment. However, one of the nice things about weeklies is, let's say you have a longer dated option contract that you're thinking about selling more than one weekly option against. You can easily avoid that higher risk assignment period by just not selling an option the week that a dividend's coming out.
Okay, good advice. Well, one more topic I want to touch on before we finish, and that's this whole idea of implied volatility. We're talking about option positions where we buy time. So, talk to our listeners about, potential implied volatility exposure.
You do have implied volatility exposure because with respect to the long option that's going to be an open position at expiration. If you sell an option contract and you buy an option contract and you're fortunate enough to have the short option expire with no value, there is some uncertainty around the long option position that's going to be remaining that you would probably want to exit. And one of the risks associated with that is a possible drop in implied volatility. So that's something you definitely want to be cognizant of if you're thinking about doing any option strategy. Any option trade that you're thinking about exiting and not holding to expiration, you definitely need to at least take a look at what the implied volatility is for these options and where is the implied volatility compared to where it has been in the past. Because that's how professionals often determine whether or not an option is expensive or cheap, is what's the implied volatility right now relative to where it has been historically.
I think really an important point you make, and a great place to wrap it up. Before we finish, as you said, you've been in the business for quite some time. You want to offer a couple words of wisdom or a funny story from your days out on the road?
Words of wisdom. I already threw that one out there, which is every trade starts with an outlook for the stock. Even if it's a neutral outlook. And Joe knows this person, so he'll find this very humorous. When I started at the Options Institute, my very first day when I walked in and met Jim Bittman, he actually suggested I lose about 20 pounds before I start getting in front of people.
The nerve of that young man.
I know. Can you imagine? But I was told, lose weight before we put you out there on the road. And I subsequently gained 20 pounds to increase my stage presence.
Oh, that's funny. Well, Russell, thanks so much for taking time to join us today. I think our listeners certainly will benefit from your expertise on these different option strategies, and continued success out on the road for the Options Institute and also the OIC. Thanks.
I greatly appreciate you having me here.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Gary Delaney, a team member of mine from the Options Industry Council. Gary, it's great to have you, and especially great to have you face-to-face here as you've joined us from, overseas there in London town. Welcome.
Thank you. It's nice to be here. It's always good to come over and see all my friends in the US. I think one of the wonders of the internet is that you can work as part of a very effective team, but still be several thousand miles away. But it's so much nicer to do it face to face.
It is indeed. So let's get right to it. Why don't we? For our listeners, Gary is, one of the OIC team members. He happens to be stationed over there in beautiful London town. Why don't you tell us about, actually, before we get into, your experiences with OIC, why don't we talk a little bit about, your background in the industry and how you eventually landed up at OIC?
Sure. Well, I had a cousin who was a sugar broker, and this would be, I suppose, in the mid-1970s. I went to spend a day with him, and I was mesmerized and impressed by the moving green figures on his, what seemed to me like a TV screen.
Okay.
I thought, this is fantastic. The prices go up and down. You can make or lose money accordingly. And that really whetted my appetite.
And that was sugar, huh?
That was sugar.
Yeah.
But then, so I was finishing up a course at university in business administration. And then I phoned up various, stock brokers and commodity brokers. And I got a job at one of the member firms of the London Metal Exchange. So we were trading things like copper, lead, aluminium.
Right.
And they had a small options book as well. And I managed that. Now, before you get too excited and say, wow, they're trading options even then, these were very basic options. They weren't a traded option like we have today in the US. These were what you would call a hold and hope option. So
hold and hope.
So you'd buy it, and you hope the price went in the direction that you had anticipated. But if you were wrong, you were just left with a duff option.
So now, did you have puts as well as calls back in the day?
Yeah, puts and calls, and we could do all the conversion and stuff like that. And we did quite a reasonable volume, but it was a very different sort of market.
Yes.
And I suppose, the knowledge which started managing that option book and selling them to customers who would be predominantly trade and large investment fund users, that led on, obviously, to other things. And then after that, I saw an ad in the newspaper. Do you remember those things? Newspapers, sort of large, bulky things?
Believe it or not, I still get 3 at the bottom of my driveway every morning.
I'm impressed. And I saw an ad for the Philadelphia Stock Exchange, which then had an office in Europe, and they were looking for somebody to join that team, which I did.
Yes.
And we did a lot of foreign exchange option business out of Europe, and particularly out of Paris. And I did that for 12 years, up until 98. And then I went to work, I'd had a time with the .com. We all did, didn't we? We wasted, 2 years of our lives, but it was fun.
Indeed.
And then I went to work for one of the futures and options clearing vendors by name Rolfe and Nolan.
Also in London?
Also in London.
Right.
So I've always stayed in that stretch of country, and then I've worked for OIC for 4 years.
And it. As you said, with the internet, with communications, what they are in this day and age, even with you over there, we're able to work quite well together as a team.
Yeah, no, it's very effective, I think. We are not, either in Europe or the US, we are not resource heavy.
Right.
So I think we do get, very good value out of all the people that we have. But obviously, people come over from the States for the conferences. There's a steady flow of traffic, indeed, both ways.
Sure. Well, I hope our listeners will find our following conversation to be interesting. What I'd like to focus on a little bit is educating our listeners in maybe the difference between how business is done in Europe, how many of the European community prefer to do, business in the U.S. listed market? Let's talk about that a little bit.
I think it may help to do a bit of scene setting.
Beautiful.
And I've got here on the sheet in front of me some contrast between the EU and the United States. I haven't included Canada or Mexico. But if you look at the EU, we have 27 countries. We have 23 languages. We have different national tax regimes. And if you look at the US, you're one country. You've got 50 states plus DC. You've got one official language, or in effect, I suppose, two widely used languages, that is, being English and Spanish. If you look at terms of population, then the EU has got about 500 million citizens. In the US, you've got 320. Interestingly,
they're all option users, aren't they?
Are they all option users? I wish. It would be very nice. But what I think is really interesting is that although the GDP is the same, around 14.6 trillion, if you look at the per capita income, the US is far ahead. So your average per head GDP is $47,000, and you compare that with only $28,000 in Europe.
Quite a difference.
It is quite a difference, and there is also, as well as these, structural differences between the two areas, I think there is also a very different attitude to self-directed funds. Now, in Europe, I think you are much more likely to see somebody putting money into a pension fund or a mutual fund, and less likely to have, IBM in their portfolio. And I think this is an important difference because if you are holding the underlying stock in your portfolio, you are more likely to write an option against it, or to trade an option against it, to hedge or whatever.
Sure.
If you've got the underlying.
Yes.
And I think the message I get out to people time and again in every presentation I make is that options are not magic. They're not magic, but neither are they necessarily risky. Right. You ask somebody an option, they say, oh, it's risky. Well, it can be risky. How much risk do you want? But really, it is a risk management tool.
Indeed.
And the more savvy investors, I think, are coming to understand that now. But, I mean, we've talked about the differences in terms of languages and numbers of country and income, but it's also important to state that the structure of the equity option market in Europe is quite different. We have 14 equity option exchanges in Europe. We're all doing, different levels of business. But most of them tend to be cleared by their own vertically integrated clearinghouse. So,
quite a difference.
It's one operation. I can understand why it's done, because it's good money. Mm-hmm. And it's a very important revenue flow to all the, demutualized, that is shareholder-owned exchanges. But that's in complete contrast to the US model.
Yes.
When we have now 11 exchanges all clearing through a single clearinghouse. So you can open on one exchange and close on another. And it's been interesting at conferences over the last 6 weeks or so. Time and again, the Europeans say, "Oh, but you have a utility clearing model, so you can get the exchanges competing,
yes,
and generating good cost savings for the user, but also the savings of competing commission rates, innovation, fee structures, all these good things."
I have one question now.
Yeah.
With the 14 exchanges, do they trade the same product on many of those exchanges?
There is some overlap on some of them, but they tend to be fairly different.
Okay, because that's certainly one of the benefits of the U.S. market as well.
Absolutely, but I suppose unless you are able to, open it on one exchange and close it on another one using the same clearinghouse, so you're not incurring more capital charges. If you can do that, that's fine. But if you can't do that, there's probably not much point.
Yeah.
And if you look at just a quick snapshot here of the largest exchanges, how they stack up in Europe. If you look at, these are 2010 figures, by the way. If you look at Eurex, then they traded 678 million equity and index option contracts in 2010. NYSE Euronext Group traded about 230 million contracts. London Stock Exchange Group about 60, and NASDAQ about 46. So you can see that Eurex and the NYSE Euronext Group are the dominant ones. But of course, if you were to have a utility clearing model, we would see more competition.
Sure. Now, from those volumes, is it true that a lot of the volume in Europe is geared towards the interest rate products?
Yes, absolutely. And I mean, often the equity option segment, these will be trades which are put together upstairs and then they're crossed on the floor, so they get a clearinghouse guarantee.
Right.
So you've got that difference, and remember also that Europe doesn't suffer from two regulators. We don't have the SEC and the CFTC. We don't have that split at all.
Right.
Although the evolving European regulatory landscape means that we're getting now overarching regulators in the EU, which obviously influence the national regulators.
Sure. Do you see any movement at all? I mean, you mentioned the profitability aspect for the clearinghouses. Do you see any movement towards a single utility?
Well, you do see on the common stock side, on the equity side, we are now seeing interoperability. So it's not utility. It's not like the DTCC here, but it's going in that direction. And I suppose it is possible, if you got a regulatory encouragement, that you could do something like that. Never say never in this business. But I think it still has a ways to go.
Okay. Here in the U.S., we've got generally speaking, 3,800 or so products listed on all the exchanges, hundreds of thousands of strike prices. Do you have a sense for how many products?
I haven't done that calculation. It'd be an interesting one to do one day when I've got nothing else to do.
Okay, and that's no time soon.
Yeah.
Well, because the proliferation of the different products here in the U.S., be it the weeklies. In addition to the standard options, option volume has just continued to grow, as have, the various types of products. So.
Yes. Yeah. There was a study, a very good study done by a TAB group, September 2011, on the flow of business from Europe into the U.S. equity option markets. And in fact, you can get it on our website, the OIC website, and you just type in TAB report. It'll bring the report up, and you can download it.
And that's at www.optionseducation.org.
That is correct.
Okay.
And one thing that he mentions there in that report is that if you look at Europe as a whole, you've got about $1.3 trillion worth of, and that is the European holdings of U.S. equity-related securities. And that is about 46% of the global total. So there are more U.S. equities held in Europe than any other particular region.
Very interesting.
All right.
Yeah.
So, obviously there are, firms that are very active in the U.S. markets, who are putting, business back into the U.S. It's about 10% of the total.
Okay.
Of the U.S. total. So we're not talking about a tiny amount.
No, not at all.
But there are a lot of competitor products out there. the equity option market isn't the only show in town. If you look at the foreign exchange products, if you look at spread trading or CFDs, all these things available. So yes, people use the US equity option market. They're more likely to use it if they already have some underlying, and we're talking institutions or high net worths or whatever. But they do have a lot of alternatives, and you have to, I think, always put yourself in the position of the broker. What's he going to make the most money out of?
That is often the driving force. You're right.
Yeah, it is. And also we see a lot of money going into bank products. That is things like warrants, which is only an equity option, I suppose, issued by a particular bank. But that's got implications in terms of the price and the spread and all sorts of things.
Well, with such a broad canvas over there in Europe, how do you go about channeling your time and making your priorities in terms of who to educate and who to reach out to?
Yeah.
How do you approach it?
It's tricky. We employ a fairly broad brush approach. And I was talking to somebody this morning, and I said, you'd like to just kiss the princesses, but it's not just that. You have to have conversations with lots of the frogs as well. And, so, I mean, pension funds are one of the areas that we're, talking to now. But again, that's a very conservative market. And I think there's lots of potential there, but it may not be immediate. We look at money managers. We look at, bank order desks. We look at high-frequency traders. We look at high net worths. We look at professional organizations. So always, though, we are trying to, because it's just me covering Europe, we are trying
You have broad shoulders.
They're not that broad. Always, we are trying to partner with other people to help us get our message over.
Sure.
And, being a objective third-party educational source, a lot of brokers find that, very, very useful. So we will come along and say, this is a call, this is a put, here are some strategies that you can do. And then on the back of that, they can, work a sales pitch or whatever.
And how about the retail client in Europe? Does the retail client differ much from, that client here in the U.S.?
I think that the retail customer is less used to holding common stock in Europe. And, there are obviously people who do hold U.S. stock. But I think, in Europe, there are less people who hold their national common stocks and U.S. common stocks, So it's a difference in attitude, I think.
Okay.
And there's a long history of self-managed money in the U.S., and you're not going to replicate that overnight.
Indeed.
Yeah.
Well, let's see. I guess before we wrap, any other, pieces that you think our listeners would want to hear about, or?
I would say have a look at the TAB study.
Okay.
Also on the website, there's a little booklet which we use quite often in Europe. It's called Everything You Need to Know About Options, and you can.
And we're afraid to ask.
And we're afraid to ask. Don't be afraid. Don't be afraid. And that's available for free download. I mean, I suppose my point that I made earlier, I would like to make again. Options aren't magic, but think how you can use them as a risk management tool. They're not just traded for our health. There's an economic, reason behind them, and they're great for positioning yourself in terms of, neutralizing risk, taking on risk, reducing risk. And you should use it for that.
Great comments, Gary. I think that's a great place to wrap. I appreciate you taking the time to join us today. And as I said at the outset, just really good to be able to look in the eyes as we talk, for our listeners here today.
Indeed. No, thank you. Thank you very much for your time. It's been great to chat.
Thanks, Gary.
Thanks. Bye-bye.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's Tools, Resources, and Good Reads, we're going to start with a brief introduction to Bollinger Bands. I learned to use these bands on the trading floor years ago. Now, you start with a fairly short-term moving average. Bollinger uses a 20-day moving average. Then you surround the moving average with a band above and below that average. Bollinger uses 2 standard deviations to define the bands. I use these bands as one of my tools to define the underlying being overbought or oversold. Bottom line here, this is a technical analysis tool to consider adding to your repertoire. Having a sense of when an underlying may be overbought or oversold builds confidence in creating appropriate option positions. Today's resource I want to be sure you are aware of are the option exchange websites. You can find them all by Googling the exchange name. Each website has its own personality, and each has an assortment of educational offerings. You'll be surprised how much you'll find. And for those of you who may not know the exchange names, we have BATS, BOX, CBOE, ISE, MIAX, NASDAQ, and NYSE. Some of these exchanges offer more than one exchange or trading platform. You'd be well served to check out these various option exchange websites. Finally, our good read today is Peter Lynch's One Up on Wall Street: How to Use the Information You Already Know to Make Money in the Market. This book is a very common sense approach to investing that emphasizing doing your own homework is the key to investing success. So that's today's Tools, Resources, and Good Reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back segment, we're going to revisit 9/11. The attacks of Tuesday, September 11, 2001 will always haunt us. I remember it like it was yesterday, sitting in our traders meeting and being handed a note from my colleague Carlos Foster, which simply read, "Plane crashed into World Trade Center." At first, I didn't give it much thought until it became apparent what had happened. The financial markets didn't open the rest of that week. I'm not sure how many of you know or remember that 2 fiercely competitive option exchanges joined as one immediately following the attacks. It became obvious that the Amex Options Exchange, located right down the street from the Twin Towers, would not be able to reopen when the U.S. exchanges planned to reopen that following Monday, September 17th. For 6 days following 9/11, exchange executives and staff, traders, runners, and clerks worked round the clock to merge, if you will, the PHLX and Amex option exchanges. The plan was to literally bring the Amex floor to the Philly floor. And when the bell rang at 9:30 on Monday, September 17th, somehow that relocation had happened. The integrity of the markets had not been compromised. Amex traders and PHLX traders stood side by side, making markets on one floor. The true spirit of America was on full display that Monday morning on the PHLX exchange. And that's it for today's Looking Back segment.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.